Technical analysis. Technical analysts study the action of the market itself rather than the goods in which the market deals. The technical analyst believes that the market is always correct. In its basic form, technical analysis is the study of prices in freely traded markets with the intent of making profitable trading or investment decisions. Basic principle of technical analysis: the trend, a rising trend, or uptrend, occurs when prices reach higher highs and higher lows. A declining trend, or downtrend, is the opposite, when prices reach lower low and lower high. A sideways or flat trend occurs when prices trade in a range without significant underlying upward or downward movement. Prices move up and down but on average remain at the same level. Trend components. Prices do not move in straight lines, instead they oscillate, forming highs and low along the way. The true definition of a trend is the formation of higher highs and higher lows for an uptrend, or lower lows and lower highs in a downtrend. By breaking trends down into their core components, we can more easily build a framework and make sure you are all on the same page before going to live chart. Trend identification. The three most commonly used methods to identify and measure the strength of a trend are higher high, higher lows, and lower high, lower low trend lines, moving average. Higher highs and higher lows. Until HH forms, we are in a sideways market, however, this does not confirm a trend. Some traders may anticipate this as a breakout only to see price return within thin channel. We also need a HL to form before we can suspect a trend. To confirm the HL, we need price to then go above HH. Lower high and lower low. Until LH forms, we are in a sideways market, however, this does not confirm a trend. Some traders may anticipate this as a breakout only to see price return within thin channel. We also need a LL to form before we can suspect a trend. To confirm the LL, we need price to then go above LH. Trend lines. Another method of identifying trends is to look at a graph of prices for extreme points, tops, and bottoms, separated by reasonable time periods, and to draw lines between these extreme points. These lines are called trend lines. Trend lines can define limits to price action, which, if broken, can warn that the trend might be changing. It consists of 1. Straight line, 2. Usually connected with 3 or more highs or lows. Use trend lines to provide market direction, or use them alongside other forms of analysis such as support and resistance and price patterns to see how the trend is continuing. The main caveat to trend lines is that by the time you have identified a trend with 3 touches, they can quite often reverse. Trend reversal. Trend reversal patterns are essential indicators of the trend end and the start of a new movement. They are formed after the price level has reached its maximum value in the current trend. The main feature of trend reversal patterns is that they provide information both on the possible change in the trend and the probable value of price movement. The harsh reality about trends. You never know in advance when they will turn. Trends, at any time, can change without any warning. You can only truly confirm a trend after the event. The methods have described today are there to provide you with a mechanical approach to trend identification. Do not beat yourself up for getting stopped out because your trend reversed. It happens to every trader. Tips. Combine the use of all 3 trend identification methods to only trade higher probability trends. Trends are easier to identify if you zoom out from your chart, or stand back from your PC, or both. If you spend longer than 3 seconds debating if it is a trend, then it is probably not a trend. Remember that trends can change direction anytime. It is your job as a trader to only trade higher probability trades and accept you will jump onto the start of an impending reversal once in a while. Thanks everyone for watching my videos. Please subscribe, like and share too.